Bruce, quite a positive day on the JSE. We've come off our best levels, but still set for a slightly positive ending, and that was despite weaker European markets, weaker Asian markets, and I see the Dow's also opened up weaker.
Yeah, I think the the market was perhaps waiting to see if there'd be any action in the closeout, the futures closeout today. That came and went without anything major happening. And I think the market is really just settling down into a bit of a trend. I didn't see the closing volumes, but at lunchtime it's sort of heading pretty much for a fairly average day. What was quite interesting was that the interest seemed to be coming back into the industrials. We've seen a lot of strength in the resources over the last couple of weeks, last 6 weeks or so, and we saw a lot of those drifting off. We saw the gold shares drifting off. We saw some the platinums and Sasol being a little bit, sort of more positive on the day, the platinums in particular. And those are specific stories perhaps, but resources have had a good run, and we saw a nice recovery coming back, particularly in the cash retailers.
Mm-hmm. Bruce, do you think a lot of the action happened well before the futures close out today, that traders were closing out the positions well ahead of now?
I think pretty much that. I think that there were probably concerns that with the December closeout that you get the risk that there's very low volumes in the marketplace and the liquidity is not there. So if you're a fairly substantial player during the course of the year, you probably would want to close out your positions a little bit earlier so that you don't get caught in any kind of liquidity squeeze that goes against you.
Mm-hmm. Well, Bruce, you mentioned some of the retailers doing pretty well today. Of course, we had a couple of the banks also doing quite well. Nedbank, a little bit earlier, was up well over 2%.
Yes, I did pick that up. I think Standard Bank was the laggard there, but not too concerned about that. It's had a very good month so far. I think it's up about 7 Rand. And the other banks have been a little bit hit perhaps by when ABSA's trading update came out. They've got a much higher exposure to the South African market, and perhaps that caused the Nedbanks and the like to sort of falter a little bit. And they're making a bit of a comeback now. I think the markets have seen the underperformance coming through from the financials. Perhaps a bit of recognition that our economy and our markets and the regulation of our markets is pretty good relative to what you're seeing in places like Greece and Ireland and Spain. So I think the market, basically the foreign investors giving us a little bit of credit perhaps for a better sort of better constructed market.
Mm-hmm. Well, there we had Nedbank closing just about 3% higher, Bruce. And among those retailers, of course, we had those retail sales figures out last week, and that was for October, at 6.5% contraction in the sector. Of course, we've had other data out which just shows how distressed South African households are at the moment. Do you think some of the retailers will do a bit better going into this Christmas than other retailers?
Well, I think if you try and imagine how the consumer is going to behave going to this Christmas, I think the consumer is going to be pretty wary of taking on big ticket items. He's probably going to be pretty wary of taking on any additional debt, and building a debt position when he's been struggling under that sort of load for quite a while now. So I think the market was, if you looked at today, where the cash retailers, the Mr. Prices, the ShopRites, the Spars, the Pick n Pays did quite a lot better than your credit retailers. I think perhaps the market had been expecting the consumer to recover a little bit faster than it appears that he's doing, and maybe they're just being a bit defensive and switching out ahead of that. I think the likelihood is that the consumer is going to go out there and they'll perhaps stay at home and have a good spread, a good dinner at home as opposed to going to a restaurant. Maybe buy some smaller gifts which they might be able to do on a one-stop shop somewhere at one of the cash retailers. And then maybe they're going to shy away a little bit from the big ticket items and the credit retailers.
Mm-hmm. Bruce, at what stage of the recovery do you think the focus might shift from the cash retailers to the credit and the furniture retailers? When do you think they're going to have their day?
Well, I know our view's perhaps a little bit more conservative than most, but the credit retailers have run very hard off the bottom, and a fair amount of the earnings forecasts or the earnings that have been based into consensus are as a result of an improved credit book and the assumption that the debtors book, not the credit book, the debtors book is going to improve relatively quickly. And our view has been that's going to take a little bit longer to unwind. So in that regard, we think that the credit retailers ran a little bit ahead of themselves, and maybe they just need to consolidate, perhaps pull back a little bit. They will eventually enjoy the leverage that they're known for, but it's not going to be the kind of leverage perhaps that you've seen in prior cycles when the market has come off the bottom and you go into a growth cycle again.
Of course, one of the worst performers today among the top 40 shares was Harmony Gold. And of course, we did have that gold price coming down as low as $1,112.50. And that's over $100 below the high point it touched about a week and a half ago. And I mean, do you think that gold has the potential to improve again? Do you think this is just a temporary strong dollar story that's pushing the gold price a little bit weaker?
Well, we would be a little bit concerned, on the gold price that perhaps the strength in the dollar that we're seeing of late is something that might be carried a bit forward into next year. The reasons being that it clearly looks like the US economy, particularly for the next couple of quarters, is going to outperform quite significantly the other developed economies, particularly in Europe, specifically Europe, Japan, and the UK. And as a result of that, there's likely to be a little bit more demand for dollars because of that economic growth, and that will take a little bit of the pressure off commodity prices. It'll possibly also take a little bit of the pressure off the gold price. And that said, the gold price, even if one just looks at it on a technical basis, whether you look on the daily or the weekly, it's still relatively well supported in an uptrend. And at this point in time, it could correct right back to about $1,050 an ounce, and it would still be in an uptrend on the daily basis. So we're a little bit wary of the gold price in the short term. We think the likelihood is that there's not going to be as much interest, and perhaps the interest is going to switch back into the platinum market where there's a better underpin to demand.
Mm-hmm. And Bruce, do you think we've seen a bit of a break in trend here? Because until last week we were calling for a short dollar, long risk situation. Now we have people going a bit longer on dollars, but still remaining reasonably long on risk at the same time.
Our view on the dollar is, having given it some thought over the last few weeks, we feel that actually the dollar is likely to remain strong, and for the reason given on the economic front of the better growth, and that there's less risk in the US at the moment. Perhaps the market's starting to take cognizance of the fact that the US companies, their balance sheets aren't in bad condition. It's primarily the US consumer that's in bad condition. The banks are repaying their TARP funds as fast as they can. And generally speaking, the US economy is not looking as bad, or it's sort of certainly come out of the recession a lot better than most other developed economies. And I think the investors now looking at it and doing what you might call a sort of barbell investment strategy, where they're going long the emerging markets with a focus on Asia, where the growth is a lot higher, and then long the US, and perhaps going short, the UK and Europe and Japan. Although on balance, Japan is already looking very bombed out, and there might be a recovery situation there.
Mm-hmm. Bruce, just quickly, PPI minus 1.2% for November, which was not quite as weak as expected. What was your view on those data?
Well, the PPI, it's still deflationary, which means that the carry through to the CPI is still to the good, or to supportive of a fall in the CPI, which again has the knock on that one would expect interest rates to remain a little bit lower for longer, perhaps in South Africa. We saw the retail numbers that also suggest that that interest rates will remain a little bit lower for longer. We're seeing the strong rand, which is also going to have a positive impact on both PPI and CPI. So at this point in time, the PPI is really likely to remain very benign for a good few months yet, until such a time as the base effects move out. If one starts looking at the movement in the rand over the last 12 months, there's still a couple of months before the impact of the base will start to turn negative on the PPI. But at the moment we've got very little domestic demand. We don't have the greatest demand for our products offshore. The strong rand is hurting our exports, and that's going to keep the lid on the PPI for a while. So we're not expecting anything dramatic to run away there. And I think the market's also waiting to see early next year, I think in February, when the announcement is made as to what the electricity price increases will be. That's going to have an impact obviously on the PPI at first, and then flow through to the CPI pretty shortly thereafter.